Inflation's come down a long way since it peaked in 2022, both in Australia and overseas. And part of this was the resolution of supply chain issues, and also energy prices easing, which has helped. But it also reflects the tightening of monetary policy all around the world, and that's helping to dampen demand. That said, inflation is still above central bank targets in many economies, and it is proving to be sticky. And the progress in getting inflation down has slowed, and Australia isn't any different here. So since the previous meeting, we've had March quarter national accounts, which has told us a few interesting things. First, the March quarter consumption data and upward revisions to its history mean that consumption growth's been a bit stronger than we thought and the savings rate a bit lower. At the same time, I think you'll all remember that GDP barely grew in the quarter and consumption per capita continued to decline. We do expect that household real incomes will rise later in the year with tax cuts and lower inflation, so it is possible that consumption growth will also be a bit stronger. But we also know that many households are really feeling the impacts of high inflation and higher interest rates. And as I noted earlier, on average, households have reduced their saving rate by more than we thought to support their spending. It's tough just to keep up with essentials. Groceries, petrol, health, education, rents, insurance expenses, I could go on, they're all going up. On the other hand, while labour market conditions are quite strong, the unemployment rate published last week was at 4% for May. Employment's still growing, it's just growing a bit more slowly than it was a year or so ago. Now, this is important for the other part of our mandate because people having jobs is critical to them being able to meet the challenges of the higher cost of living. Wages growth in the March quarter was a bit weaker than expected, and we think it's likely to have passed its peak for the current cycle, but growth of unit labour costs was still a bit high. The monthly CPI indicator for April was stronger than expected. However, there's been limited information about services inflation since the May board meeting, and this is where the most recent strength has been coming from. So really we need to get more comprehensive readings on inflation before we can get a handle on the momentum in services inflation. So what does this all mean? Well, the recent data have been mixed, but overall I think they reinforce the need to remain vigilant to the upside risks to inflation. We still think we're on the narrow path. It does appear to be getting a bit narrower. We need a lot to go our way if we're going to bring inflation back down to the 2% target range. The board does need to be confident that inflation is moving sustainably towards target, and it will do what is necessary to achieve that outcome.